Hi, everyone. Welcome to the webinar. We're going to let some more people flow in here, and then we'll get started in about a minute.
Tremendous.
Okay, so as more people continue to join, I'll just read our quick introduction. Hello, and welcome to Accounting for CEOs, a four-part series. I'm Julie Cranston, Director of the SBDC at UCI Beal Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UCI Beal Applied Innovation in partnership with TGG Accounting, our fabulous partners, TGG. The SBDC is funded in part by the U.S. Small Business Administration and the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing no-cost expert consulting and training such as this webinar. In addition to our regular consulting on business management and equity funding, we've also been helping our small business clients understand and apply for SBA loans like the Economic Injury Disaster Loan or EIDL program, and also the Paycheck Protection Program or PPP loan. We can also help advise on how to administer these loans and apply for forgiveness if you receive them. So make sure to reach out to us if you need assistance. We have a hotline set up and additional resources available. The hotline number is 1-800-616-7232, and I put that number in the chat. And if you're a tech or life science business, you can go straight to our intake form at sbdctech.org/contact, and that's also in the chat box. We also have a COVID resource guide available at ociesmallbusiness.org. We'll put this information in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. We may not get to everyone's questions, but we will do our best. If we don't get to your question, please email hkhaled@fullerton.edu, and we will attempt to answer them and get back to you. Our program today will be presented by Joe Johnston, Senior Accounting Manager at TGG Accounting, as well as the Director of Business Development for the LAOC region. During his time at TGG, Joe has supported businesses from the startup size through middle market growth and transaction. While industry agnostic, some of Joe's favorite clients have included medical technology and SaaS businesses. Joe has hosted dozens of technical and managerial accounting trainings for accountants and business owners alike to help them understand the power of operational finance. Joe received his MS in accounting from San Diego State University. Joe, thank you so much for being here again today. I'll now turn the program over to you.
Thanks so much, Julie. Always fun to work with the SBDC, and howdy everybody who's joining us here today. So wonderful to get the chance to chat with you. As Julie has mentioned, our series, today we're going to be kicking off the first in our four-part series, which is Accounting for CEOs, highly intended for startup CEOs kicking off our careers here. So I won't overdo this, but as Julie has mentioned, my name is Joe. That's what I look like at least a few years ago. Now this is what you get. But I'm our Senior Accounting and Business Development Manager for TGG Accounting in the Orange County and LA area. And a brief idea on TGG Accounting. In simplest terms, TGG Accounting provides outsourced financial and managerial accounting for small and middle market businesses that are looking to run their business by the numbers. So if you're looking to sell your business in a few years, if we're just trying to knock Coca-Cola off the top and figure out how we can get to that level of profitability, or we're just looking for that lifestyle type business where we can pull out 10, 15, 20 grand every month in good shape, we're working with business owners to help them accomplish their goals. Key takeaways from today, just so we know what we're getting into in the start of our series here. We're going to start out with a very conceptual understanding of accounting and the different ways we should be looking at it from an executive level. We'll talk a bit about why good accounting matters and separating it from a value perspective and a cost perspective. We're going to talk a bit about reading basic financial reporting. So if you are coming in from a science background, a tech background, and not exactly a business and a financial background, we're going to give you some basic information here that you can use to get a better visual into your business. We'll talk a bit about KPIs and how we should be connecting those to our financial reporting, and get an introduction to the next part of our series here, the next 3 sessions, which is looking at the TGG Way basic business model and the price of value matrix. which are going to be really integral in comparing our business to others in the industry and figure out where we should be focusing our efforts in taking a financial look at our business. So to kick us off, let's start out here, ground floor. Let's just set the basis. What is accounting from an executive level? I know we already feel pretty comfortable with this answer, but let's boil this down to two factors. There's two perspectives. One is the activity perspective, right? All the processes that we need to manage through our business that an accountant or someone acting in that capacity needs to manage, whether that's—
Hi, Joe. Sorry to interrupt. Your mic is cutting in and out.
Oh, excuse me. While I continue on here, let's pause for a moment and let's see if I can call into the meeting here as well.
Thank you.
Excuse me for the brief interruption.
Thank you for your patience, everyone. We will continue shortly. You are on mute, Joe.
Hi there, team. My apologies. Thank you for sticking with us through that brief interruption. You guys picking me up okay now?
Yes, thank you.
Wonderful. Thank you for that. Better to do that now on the front end. So team, when we're talking about accounting and looking through this, we want to look at this from two perspectives. Our activity perspective, which includes paying bills, paying our taxes, paying our employees, contractors, services, collecting in money from our customers, and really making sure that all of these are happening in a smooth process. And of course, the second perspective that we'll be looking at is a decision-making perspective. We need to have good financial reporting so that we can figure out whether or not we're actually going through our activities successfully, whether we want to adjust them, and really how we want to make some strategic financial decisions in our business. As we said, our activity perspective may include any of those listed here, including those on the startup side that may just be contributing money into your business, investing money in the business, picking up loans for your company, and going through those activities successfully. And of course, from the decision-making side, we want to make sure that we are able to review financial performance. We understand what the business owes and owns, and we have a basis to make decisions. If we don't have good, strong financial accounting, we won't have a good, strong basis to make decisions such as what products we want to keep selling or change. How many employees do we need to be profitable to make sure that we're covering our costs and make sure that we're able to keep up with sales? And where should we get financing from, and other questions. But what I would tell you here going forward is that for many businesses, we need to decide whether or not we're going to be treating accounting as a cost or as a value and a benefit. If we treat accounting as a cost, it'll be just as so. We'll be going to spend the least amount of money possible that we can We'll be going through basic bookkeepers to just make sure we have the minimal level of effort to go out and collect from our customers, to send out invoices, and really we'll just be trying to go through our activities without investment and thought. If we treat it as a value, we can really drive our business by the numbers. Let me start this out by telling you a story about our CEO, Matt Garrett. Matt Garrett started out in the business community after graduating from Vanderbilt University in the 1990s and started a dot-com business. When he was working through his business, he was treating his accounting much like a cost. How can I drive down the cost of accounting? How can I get cheaper bookkeepers? How can I just go through the activities that are required of me as a business to keep the wheels on? And where this really led to is him transitioning out 5 bookkeepers over a span of 3 years. When you start to see things such as negative cash balances, if anybody can pull out negative cash out of their wallet, or seeing negative accounts receivable, where it almost looks like you owe your customers money. All of these things led to Matt Garrett not being able to make strategic decisions in this business and not being able to maximize one of the biggest drivers of value for a business when you're going to sell, which is Ebitda. When he went to sell his business, not until after the fact did he find out from his valuation firms that he had sold his interest for 10 times less than he should have because he didn't use accounting to make better decisions and increase his Ebitda. I can't imagine putting all of the effort over 5, 10, 15, 20 years, whatever it would be, into a startup to go out and try to sell. And after all of that energy, leave a 0 off your purchase price because we didn't make decisions that were going to help us raise our profitability, raise our operating income, and go for a higher selling price. This is why TGG actually came into the picture and was created, because we don't want to see this happen again. When we talk about bad accountants, what I want you to be able to do is identify bad accounting habits from whether it's your own staff or a firm that you're working with, whatever that might be. When we're looking at accountants and bookkeeping from a cost standpoint, bookkeepers only do what they're told. They're reactive and not proactive, just like in any other position. And they don't work with you to help manage cash and be proactive with deals that we can take advantage of for a business. On the other hand, good accountants, true accounting, elevating yourself out of bookkeeping, accountants will find a way to help you improve your business, increase profitability, approach you with new ideas to say, you know what, maybe all of our competitors have raised their prices in the past 5 years, and really we haven't done that. Maybe we should go ahead and do it and see how the customers react. Maybe we should see if we can send out invoices sooner to get cash in sooner. Your accounting team, or you and yourself, if you're going through the accounting processes in your startup, should be thinking through these types of proactive activities in accounting. If it's just a task, we're really not taking advantage of the value add thought processes that we can. Now, to approach accounting from a strong standpoint, for those of you that are coming in from a non-financial background, we're going to spend a bit of time here talking about what are some of our basic financial reports that we'll see. What are some of the ways that we should look at them for our business before we move on to our KPI section. So our 3 basic financial reports for any business in this order are going to be your balance sheet, your income statement, and your cash flow statement, also known as your statement of cash flows. In simplest terms, your balance sheet is going to tell you what you own and what you owe. Your income statement is going to tell you your profitability of your business, recognizing all the revenue from selling your goods and the expenses of your business. And your cash flow statement is going to be telling us how we're getting and utilizing cash from various sources. Focusing on our balance sheet, what we really want to focus on here is something that I really enjoy, that I think is a simple way to understand our balance sheet, is that everything that your business owns was paid for or received through either debt taken on by your business, right? Whether that's loans and we're putting cash into the business, or we have payables, bills that maybe we purchased a piece of equipment and now we have a bill that we need to pay out. We have equipment, but we also have a bill. Or it was received through contributions and efforts of the management team. If you've invested $10,000 in your business, we should be seeing $10,000 in cash and $10,000 in equity in your ownership. That's why the most basic accounting equation that's easy to understand here is that your assets, everything that the business owns, should be equal to our liabilities and our equity combined. Now let's take a look at what that should look like on our balance sheet. This is what your balance sheet might look like in the most basic form. Your balance sheet will always be as of a specific date because it could change day over day over day. In this case, we can see that our assets, our $100,000, is equal to our liabilities and our equity together. But let's move this forward up a notch. Let's talk about how are some of the ways that we should be categorizing our balance sheet so that we can really understand what's happening in the business to a certain degree. In this case, what you'll see here is we still have our total assets at $87,000, and we have our liability section and our equity down at the bottom, which are totaling out $87,000. But moving on down here through our assets section and through part of the liabilities, well, you'll notice that we have subtotals here for current assets and current liabilities. And these are one of the most critical factors that we like to teach startup business owners and small business owners to really break out separately when they're looking at their balance sheet. Now, a current asset is something that will provide a benefit to us in the next 12 months or turn into cash in that next 12 months. So to say, going down our list here, cash is cash today. Accounts receivable are the sales that we make to our customers that are going to be turning into cash for us. And our inventory here that we're holding at $5,000, we're going to be able to sell it either for cash or we're going to sell it and it's going to turn into an accounts receivable that we'll be able to collect in terms of cash. So all of these things are going to turn into cash for us within the next 12 months. Looking down below at our current liabilities here, you can see that we have accounts payable, which are really just the bills that we owe, and we have the short-term portion of a loan. Now, something that we really encourage for our business owners, if you have an SBA loan, if you have a payroll protection loan, if you have any other type of loan, commercial loan, line of credit, we want to be able to separate out what is the current portion of that loan and what is the long-term portion, because that's going to tell us what we need to cover in terms of debt in the next 12 months. Now let's take a look at what we can do with some of this analysis. In this case for the business, here we can see our current assets are at $67,000 and our current liabilities are $11,000. So we can feel comfortable that we'll have the ability to pay out our debt that's due in the next 12 months with the assets that we have incoming or already on our books. Because we have a current ratio, which is our current assets over our current liabilities of over 6. When we're looking at our current ratio, this is really going to give us an idea of short-term safety. If you have a current ratio that is less than 0, we might have a liquidity issue. We may not be able to pay our bills or service our debt unless we pump other sources of financing into our business, which are going to need to be long-term, or make a contribution through equity, more cash. For most of our businesses, if we say we have a current ratio of 1 to 2, we're in a safe zone. We don't have an overage of cash over our liabilities, but we can feel comfortable that we can cover our debt. If you have a current ratio on a consistent basis that is in excess of 3, in excess of 4, really we're starting to talk about more investment grade levels of cash on hand, investment grade levels of receivables on hand, where we can start to take a look at, do we want to invest more back into our business, or do we want to distribute out of our business? But we can't look at a current ratio just by itself. Let's take a look here and take this to another level. If in this case, if we are an inventory-based business, let's take this same business we were looking at a moment ago, where we pulled out $60,000 in cash. If we had spent $55,000 of that and pumped it into our inventory, our current ratio would be unchanged. We still have $67,000 of assets that we're going to produce that are going to turn into cash in the next 12 months. But what happens if we have a specialty product and we can't sell our inventory? Oh, well, maybe we should create a separate ratio to look at this. This ratio is going to be called your quick ratio. Your quick ratio removes inventory from the picture and says, if I'm unable to sell the goods that I have on hand, am I still going to be able to cover my debt in the next 12 months? Because at the end of the day, if I have accounts receivable, money that's due to me from customers, I can always put in extra effort to try to collect sooner, or I can try to go out and sell my receivables to get, maybe at a discount, to get some cash now. But in this case, we really may not be able to sell out our inventory and get it off the shelf if it's a specialty item, if our customer base drops off. Think about what happened at the start of COVID when we had retail shelves that were stuffed with inventory that they couldn't sell until they were able to move it online. So this could be a great factor to consider here. We don't want to take current ratio by itself. Now, this is just an example of a few ratios. People spend their whole lives reviewing the balance sheet and financial statements, but what I want to do is give you an idea of what some of those KPIs could be. Let's take a look at our income statement now. Your income statement is going to show the performance of your business over time, and it shouldn't look too intimidating. Let's break this down in the simplest form. Your income statement is going to start out with sales revenue, how much we get for a product or service. And then your cost of goods sold, or cost of sales for your business, is how much does it cost me to produce that good or that service. So if I'm an inventory business, it's going to be how much does it cost for me to make my widget so that I can sell it. If you're a service-based business, then maybe it's how much does it cost me in terms of payroll to pay my people to go out and repair houses or whatever your service might be. That gets you to your gross profit. How much do we make on our product or service? The next step here is your SG&A, selling, general, and administrative expenses. This piece is really all of your back office, back house, saying if we have salespeople that we need to pay to go across the country, if we're paying for a marketing firm, if we're paying for office expenses such as rent, facilities, we're getting supplies for our business. All of these are going to go into your SG&A to get us down to our net operating income. The last step in our marker here is looking at other income and expenses. Other income and expenses really says what is outside of my operating business model. If we're thinking about McDonald's, for instance, McDonald's is in the business of selling cheeseburgers. All of their revenue from all of their cheeseburger sales are going to go right into sales revenue. Their cost of goods sold are going to be the price of the product and the price of people, labor going into making those things. But if McDonald's, for instance, sold their walk-in refrigerator at a profit or at a loss, the income from that, which is totally unrelated to their business, will go into other income and expenses. We want to break these out separately so that we can understand the tiers in our business. When I look at an income statement, I typically look at it in 3 different tiers from a 10,000-foot level view. First is looking at our sales revenue. In the easiest sense, it's P times Q, price times quantity. Am I selling enough of my product and am I priced okay? The next tier is looking at our gross profit. Am I making enough to cover my costs of actually producing my good? Whether we're at an 80% margin business because we're Walmart and I sell it costs me $4 to make a t-shirt and I sell it for $5. Or if I'm Neiman Marcus and it costs me $4 to make the t-shirt and I sell it for $20 uppriced, that's going to be our cost of goods sold. And then, of course, looking at our net operating income, figuring out if our operating model, in terms of all of our back office expenses, are profitable. We want to start tearing apart our P&L, looking at it in these different stages. And we're going to talk about this in more detail when we get to our basic business model. Our final financial statement that we're going to be discussing is your statement of cash flows, which shows the sources of increases and decreases in cash over the period. Your statement of cash flows is going to break down cash into 3 different sources, 3 different uses. And these are really critical to understand here. We're going to have cash flow from operations, which is what we do on a daily basis, going out and selling our product, net income from the prior period, all of our receivables that we've been collecting, all of the bills that we've been paying out. Moving on to our financing activities, this is when we're getting funding and loans in from the business, or we're paying back loans. And then finally, here's our investing activities. Investing activities are when we're either increasing our production capacity in the business by buying such things such as large pieces of equipment that allow us to produce more inventory, or it could be investments made into the business from a member or a contributor. Now, if I was mentioning all of these here, the most valuable source of financing activities in cash, the gold standard, whether we're going to keep our business safe or if we're going to try to sell our business one day, is of course cash flow from operating activities. Because what this tells us is that your business is able to finance itself. This is what your cash flow statement is most likely to look like. Your cash flow statement, when you start out, if it's in an indirect format, is going to list all of your operating activities here, finance activities, and of course down below your investing activities. Here we'll see that just for a couple quick examples here, you see that we've received $20,000 from net income from our prior period, but that we have a $500 increase in cash from accounts receivable. Now what that really means is not that our accounts receivable has increased, but it means that we've collected the cash from our customer, which is true cash flows. If I make sales all day on credit, but I never collect any of them, it's not going to affect my cash flows. In fact, it's actually going to decrease my cash. In this case, you can see that we have a decrease in cash related to accounts payable, which means that we paid a bill, getting us down to $19,500 in operations. As we mentioned, I won't go through all of these, but in our financing section, you can see the various loans that we're balancing, whether these be pay downs of loans from SBA, loans to owners, and of course, contributions made from our owner. What we really want to look at down here at the bottom are our different sources, of course, and your total change in cash, getting us down to our cash at the end of the period. But let's take a look at what this is most likely to be for startups on the front end. If you're pre-revenue, we haven't really made a first sale yet, this is more likely what your cash flow is going to look like. We're going to have a lot of cash pumped in from financing activities, if those are SBA loans, if those are owner loans from other sources. We'll have cash contributed from investing activities, from member contributions, and getting up to your operating section, it's going to look a little tough. We're going to start out with probably with net losses from expenses we've incurred without any revenues. But what we really want to do when we're taking a look at our cash flow is keep an eye on this on a monthly basis. And something that we can do even more so is create what would be called a 13-week cash flow forecast. Your cash flow forecast takes what is that cash flow statement and projects it out over a 13-week period of time, which is a financial quarter, allowing us to understand where are we now, of course, with our cash, but where are we going to be over that period of time. We can plan out when our first sale is going to happen, figure out when we're going to be paying bills to make sure they're paid on time, but I'm not paying them early. And of course, figuring out when we need to push money into the business from one source or another. So highly recommend a 13-week cash flow forecast for your business. Now that we've gone through our financials, and we've talked a bit through what those are really going to be looking like for our business owners, what we want to talk about here is understanding key performance indicators and those connections to financials. As a business, whether you're a service-based business, a manufacturing business, a technology, software business, medical, whatever it is, there are going to be certain numbers and figures that are going to tell you about how well your business is performing. Now, those key performance indicators are going to be unique to your business. But what we really want to separate out here is not confusing the idea of a key performance indicator and a financial metric. A key performance indicator, say for a real estate business, maybe how many new houses did we sell? What was our gross profit per sale? Or if we're a inventory-based business, how often was our inventory stuck on the shelf, right? I've worked with a street sweeping business where their key performance indicator, interestingly enough, was gas expense. How much gas am I spending to go out on routes? But we really want to identify here in thinking about your own business, what will be some of those factors that will say, when this number is moving positively, I can feel comfortable that my entire business is moving in a positive direction. That difference there between a key performance indicator and a financial metric is that a financial metric really just may be used to highlight one specific side of your business. That may be something such as what we were talking about, our current ratio and our quick ratio, just making sure that we have good financial safety. That won't necessarily tell us, am I selling my inventory well, or is it even priced well? But it's still a good metric for me to track to figure out how am I doing in terms of financial safety? Will I be able to cover my debts and my bills? So something to keep in mind as we're moving along. Now, as we're going over our industries over the next 3 weeks, we're going to be identifying some KPIs for industries. But KPIs for specific industries will be very different as those you see here. And those for your business may be unique to you as well. Something that we use at TGG that I would really encourage is a strong financial metric and KPI called the triple bottom line. This is something that we found to be universal across all businesses to understand what's your profitability, how are we doing in terms of cash safety, and really how are we doing in terms of long-term safety and equity. And I'm going to talk these through with you today. These are something that are really easy to implement from your business. If you have a balance sheet, income statement, and cash flow in good standing, this is something that you can take away and start tracking. The triple bottom line is going to start out with net income from operations. This is telling us our revenue, less our cost of goods sold, and SG&A, getting us to our net operating income. Net operating income is the gold standard for profitability. If we're getting all of our profitability from strange sources of income, McDonald's selling that refrigerator, then our business isn't necessarily in good standing. We want to check our net income from operations over a trended period of time. One adjustment to net operating income is Ebitda, which at the end of the day, if you are looking to sell your business, Ebitda is going to be a primary measure used to value it. The next value here, the next piece of the triple bottom line is our net cash flow from operations. As we were just discussing, our three sources of cash flows are operating, investing, and financing. And if your business is producing all of its cash flow or a majority of its cash flow from operations, then it can really fund itself, and we can feel comfortable about that. If it can't, we may want to figure out where we can make some adjustments. The last piece here is tracking our net equity. Our equity, to think about this, is looking at what is our overall recurring profitability in the business coming in through net income, and are we over levered in our business, so to say? Have I distributed too much money out of my business, or have I contributed quite enough money to my business? When you track all three of these together and look at them, they can really tell you the story from a financial perspective and what's happening in your business. So let's move on here for a quick introduction to what we're going to be talking about in the next 3 weeks, including our basic business model and the price value matrix. So starting out with the basic business model. The basic business model is something that I didn't create, but our CEO and our president, Matt Garrett and Andrew Ruff, created through the course of our business over the course of 15 years, which was really put out there to compare businesses across industries. As we're speaking with business owners and we're hearing from them, well, my service-based business is different. You know, I go for high value versus low value. I'm trying to price myself differently. The basic business model within your industry is going to give you a way to reflect on where should we be paying attention in our business. We've looked at thousands of businesses over the course of the 15 years that we've been working, and we have figured out exactly where you should position yourself, whether you're high value, high price, or low value, low price as a cost cutter in your basic business model. Now, here's what I really want you to think about. In the basic business model, we're going to start out with your P&L, as everything is a factor of revenue. Is our revenue is, of course, 100% of itself, our price times quantity. Our cost of goods sold, how much does it cost us to produce our good or service, is going to be 50%, getting to our gross profit. How much did we make on that sale overall? The next piece, our SG&A, as we mentioned, is all of your administrative expenses, anything that's really not pumped into cost of goods sold. Anything that it doesn't cost you to produce your good is going to be an SG&A if it's not on the balance sheet. To get us down to net operating income. This at the end of the day is our take-home pay, how much we're going to be able to pull out of the business and keep tracking through our triple bottom line. Now, looking at the basic business model, once you get yours in this format and we understand what industry and how you're positioned, we can start taking a look at how this is going to affect overall profitability. If you're positioning yourself in a way where your cost of goods sold is really 60% of revenue instead of 50% where it should be for maybe a service-based business, then let's see how this trickles down. Now suddenly your gross profit isn't 50% anymore, it's 40. And our SG&A won't have changed, but now we've completely removed our net operating income. We might be at break even. We're even worse if our COGS or our SG&A have improved, have increased. So we really want to figure out how we can use the basic business model to benchmark your company against others in the industry. But to be able to do this, we have to figure out where you are in the price value matrix. The price value matrix is where all businesses live, right? Whether you're Walmart or you're Neiman Marcus. We're going to say that Neiman Marcus, in this case, both of these companies are going to produce, retail products, T-shirts, whatever it might be. Up here in your high value, high price, you're going to have companies like Tiffany's, Neiman Marcus, your BMWs, right? Companies where what they're producing is they're saying that they're producing something at a high price. They know that, but it's a high value, right? We're going to be going out and saying this is exceptional high quality. You're getting the name, you're getting the all the special bells and whistles associated with it. Now you can tell people that you're wearing that Neiman Marcus clothes. But down here at the bottom, what we have is we have our cost cutters, right? The ones that are moving to say, you know what, we're offering our product at a low price, but it's also lower value, right? It's not quite as nice of a shirt, it's not quite nice clothing, but at the same time, we're going to be able to still make great margins on it. And what I want to tell you is that as long as your business lives here, then you're going to be able to make money. And this is going to affect your basic business model. If you're low value, high price relative to your industry, no one's going to buy anything from you. And if you're a high value, low price, you're not going to make any money. We want to make sure that your business relative to your industry is living here. And this is where true profitability is going to be for you. So let's take a look at what we mean by that and how those are going to compare. So taking a look at Neiman Marcus on our left side here, comparatively thinking about this, we understand that to make a cotton t-shirt, it's the marginal difference in cost is not that significant between maybe a Walmart t-shirt or a Neiman Marcus t-shirt, or a piece of clothing that we're making. But at the same time, we're able to charge a much higher price because of our brand name, which is going to land us a much higher gross profit. But to do that, to make this work, we need to hire models to go wear our clothes. We need to go out and do extensive marketing campaigns. We need to go out and spend quite a bit more money in keeping our brand right in front of people and making it look as good as it can possibly look. Walmart, on the other hand, really, they're hardly making any money on their products, right? They have economies of scale. They can charge low prices because it costs them less to actually produce it. So they're accepting a lower gross profit. But at the same time, they don't have to go out and market. You know who Walmart is. You know that they're convenient. You know that they're always there. We know that when they're open, and that they're all going to have consistent products across the board. So they don't have to spend all that extra money to have people modeling for them and doing all these things, so that we can come out at the end of the day with the exact same net operating income. So we need to understand how you are positioning your own business relative to the industry to make sure that we are focusing the right energy and saying, is our COGS appropriate? Is our SG&A appropriate based on where we are on the price value? Now, key takeaways from today, gang, as we walked away from this, we've talked a bit about accounting and that activity and conceptual perspective. We've looked a bit about why good accounting matters and how it's going to help you accomplish your goals. We've talked through the financial reporting, which hopefully you got some good tips out of there. Looking at our KPIs, connection to financial reporting and identifying those specifically for your business. And of course, we've given our brief introduction to the basic business model and price value matrix. Now, over the course of the next 3 weeks, what we're going to be doing is we're going to be diving into specific industries looking at the price value matrix, looking at the basic business model, and taking a look at KPIs that you can consider and look at for your industry. So if you're operating in these industries, you're interested in starting your business in these industries, please join us. We're going to have some great time chatting through and listen to any of your questions as we're working through them. If you have any questions for me, for TGG, always feel free to reach out to us through social media, through emails here. Of course, we're doing training through TGG University to teach and coach people that are doing their own accounting, if you are in that space. And with that, I'm all wrapped up. Happy to take any Q&A.
Thank you, Joe. I'll hop right in. So our first question
Absolutely.
is, how do you compute the CR?
So your CR, your current ratio, is your current assets over your current liabilities. So if it's going to turn into cash in the next 12 months, that's going to be a current asset, or you're going to get the benefit of it in the next 12 months. That's a current asset. So your cash, your prepaids, your receivables, your inventory that you're going to sell. And your current liabilities are going to be any of those obligations that you have to pay in the next 12 months. So bills that we're paying out, credit cards that we're paying. If you have a loan, just because it's a 5-year loan doesn't mean that it's necessarily all long-term. We want to make sure that we're separating out any piece of it that's short-term that we need to pay in the next year so we can keep an eye on it and track it.
Is net income the same as EBITDA?
Net income is not the same. Net income is also going to include accrual basis entries such as depreciation and amortization, which is the way that you expense large fixed assets or intellectual property in your business. Ebitda is earnings before interest, tax, depreciation, and amortization. So it's going to remove out all of the interest because if someone's buying your business, they're less interested in how it's financed because they're probably going to provide that financing as long as operations are good. It's going to remove taxes because those aren't out of your control, and depreciation and amortization, which are really our accrual basis entries and could be subjective based on your depreciation method.
What specifically goes into calculating COGS? Beyond the obvious costs from the manufacturer, etc., I import product from overseas. So would things like broker fees, duties be included in COGS?
It's going to depend more specifically on your business. If we are offshoring our manufacturing, anything that's going to get that product to its final saleable condition is going to be included in COGS. That's our basic model. What we might want to take a look at is the contracts and how those are going to be positioned. So happy to chat about that offline here.
Will you be discussing nonprofit accounting at any point?
It's not scheduled, but if we get enough requests, certainly happy to do that, or we can talk about it separately.
How do you calculate operating expense if all expenses are mission related versus non-mission related?
Very interesting. I'm going to guess this may be a nonprofit related question. What I would say is that when we're talking about our operating expenses, these are the costs. First of all, let's exclude anything that's our cost of goods sold, right? Anything that it takes to produce our piece of inventory or the service that we're providing. Our operating expenses, so we're going to segregate out those COGS. The next piece, when we're talking about our operating expenses, I'm looking at all of those administrative and back office side costs, right? Whether those be, we could group together all of our SG&A and call it operating costs, including selling, marketing, office expenses, facilities, utilities, and really group it all together. And then you can break those out separately depending on the level of granularity and visibility that you want to say, okay, I really want to track marketing separately. I really want to track my office and facilities separately because I have, if you have a cannabis business, you may have really high rent and utilities that we're pumping into the business. So it's going to depend slightly on your business, but you can go for a large level of granularity or really fine level of granularity.
A request to go back to the slide that lists the different industries for the upcoming weeks.
Yeah, absolutely. Here we got going on for the next few weeks, guys. It's noon every Thursday this month.
And then what's the definition of a KPI?
let's keep it simple as possible. It's going to be your key performance indicator. So what is going to be key? What's going to be the most important thing in telling us the performance of our business, right? So if that's the example that we had is if it's a real estate business and we're going out and we're buying and selling homes, it might be how many homes did we sell? What's our gross profit per sale? What's the average time that we're holding it in inventory before we sell it? So depending on your business, you're going to have different KPIs that are going to be important for you. During these sessions, if you're in one of these industry groups, we're going to be talking about KPIs for these different industries.
Is owner's draw for a corporation a liability or asset? How should it be reflected on the balance sheet?
So an owner's draw, there's two different ways. There's a lot of different ways that owners can pull money out of the business, right? So we can talk about, if you want to pull money out of your business, we can either treat it as a distribution, which is to say that it's coming out of your capital account. So you contribute money in, and now we're pulling it out, and we want it to affect our equity. If we don't want it to affect our equity in the business, we can create a loan from your shareholder. So your shareholder, your business could effectively loan the money back to you with or without interest, and you could pay it back at your leisure. And other ways that you could do it are through things like guaranteed payments. If you're not an LLC, you could make it a salary and a few other methods. So happy to connect on that as well.
Is it possible to download 13-week cash flow forecasts?
Yes, absolutely. We have a model. There's quite a few online, but we do have one on the TGG website. I'll provide a link to Hannah, and maybe we can get that out here a bit later on.
Do we get to variances like the cash flow forecast?
I'm not sure. I'm not sure that I answered the question, but what I would say is that if you're looking for the cash flow forecast, I'll send a link out to Hannah, and maybe we can get that distributed to the attendees here. So if you're interested in learning more about it, the important thing when we're talking about a cash flow forecast is first you need to have a correct balance sheet and income statement, right? Your cash flow is going to build off of those, right, to get you your cash flow statement. And then based on that and the history of transactions that you're seeing, such as how often am I paying payroll? Maybe I know it's twice a month. You can use the things that you know like that when you have to pay your car payment to project out cash flows over the course of that 13 weeks and keep it as a rolling weekly period.
Do you have a sample spreadsheet used to calculate all these metrics?
Quite a few of these metrics I would say are pretty commonplace online. I don't have a spreadsheet just direct for them, but a lot of these, if you look at your type of business, whatever that might be just for yourself that you're interested in going into, and you want to look at balance sheet financial metrics that aren't exactly KPIs, I'm sure you're going to find those quite easily through Google and online. Understanding if you're an inventory-based business, current ratio, looking at your quick ratio, and other sources as well. But always happy to chat about these. And if you are in one of these industries, we're going to be going not just on the financial metric side, but to the KPI side to figure out what's really specific for your industry that may be important to look at.
On the balance sheet, what is the significance of the values in the equity section in terms of assets equal liabilities plus equity?
Yes, so the significance of value of the equity section. So your equity section is really going to show you, for most startups, I'm not going to get into like big business here, but for most startups, small and middle market businesses, your equity section is going to include all the money that you as an owner have contributed to the business, right? So if we just cut a check, contribution, got my equity in the door, it's going to track that there. So you can always figure out how much you've contributed and track it. It'll recognize any distributions you've taken out that you want to impact equity. So say you go into a business with multiple partners and you're going to buy one of them out, you might cash out their equity section. And the other big piece of it that every business is going to see regardless is going to be retained earnings, unless you're an LLC, which is going to show up later. And retained earnings, which lives in your equities, which is going to live in your equity section along with net income, is the accumulated profits of your business. So whether you have net income or you have net loss at the end of the day for your prior year, all of those accumulated net income and net losses from the prior years are going to live in the equity section of your balance sheet to say, this is how much money we made or lost last year that impacts our business.
We are both a service business and we sell products manufactured by others to our customers, about 50-50.
Yeah.
These services,
sorry, I was just excited.
It's okay. These services and sales take place at customer locations, so we don't have a retail store model. How do you know what area to focus on when we are not a manufacturer, retail, or straight service? The blended model adds complications when looking at financial statements.
I would say, I don't know exactly what your business is, but what I would say is this is something that anyone who sells product plus service deals with on a regular basis. It does add extra layers of complication, but we can make it easier to look at by breaking out your different sources of revenue and cost of sales. So for instance, I work with a business that's a contractor services business. So they'll go out and they'll repair homes, but at the same time, we also have to sell all of our upfront costs, right? Are we installing a new windows, screen door, garage door, whatever that may be? So we're going to be selling those at a certain amount of markup. So as long as you track your service, the revenue from the service component of your business and the cost of your labor from the service component of your business separately from the price that you're selling out your product and the cost of you to produce that product, then we should be able to get good visibility and make sure that your margins are appropriate for the business. So we really want to figure out what your overall profitability should be on each of those and track those down through your P&L and make sure we're in good shape.
Suppose you're a human capital-based consulting business billing by the hour. Is there a COGS you would account for in having to make business improvements in order to take on a certain client, or would that still be an operating cost?
Great. So you're talking about like my kind of business, right? So an accounting firm, a legal firm, any kind of business professional firm. If all of our cost of goods sold are going to be related to utilization, right? So people working on clients. If you're talking about a business where you're T&M, right? I'm billing the time of my consultant to somebody, then all of that is going to be your cost of sales. If we're talking about investing time into, say, building new products, building trainings, or building other types of materials, those are either going to end up in your operating expense section, right? If those are just expenses, say maybe you have one of your consultants creating a training similar to this, where they're going to be training their internal staff, you might put that down in your personnel and training expenses. But if they're building something that is going to be, say, a future product, a future initiative, right? Whether that be certain types of metrics, spreadsheets, a tool, whatever it is, something that you're going to be able to sell eventually, what we may want to turn that into is tracking all of those hours and that time as almost a construction in progress type account, really for an intangible in development type account for the IP that you're building. So if you're allocating cost to that and time in terms of the labor of your people, we want to track that separately. And you may be able to get some great benefits at the end of the day. If you're producing a piece of technology that you're going to be able to sell, you may be able to get some tax benefits at the end of the year related to the IP.
What does depreciation and amortization really mean in layman's terms? How do I identify and categorize these aspects of accounting?
Absolutely, great question. So in the general sense, right, let's talk about depreciation in the simple form. So if I am an inventory-based business and I am going to make widgets, and I already have one machine that makes widgets, and now I'm going to buy a second machine that makes widgets so I can make twice as many. This machine is not something that I'm going to end up selling, but it's going to provide benefit to me over the course of its life, its useful life. So in accounting terms, the way that we track this is it ends up on our balance sheet in an account called a fixed asset account. And over the estimated useful life of that product, which is how long we're going to end up using it, we're going to very slowly expense out the costs. So if it cost me $10,000 and we estimate that we're going to be able to use it for 5 years, then I'm going to be breaking down that $10,000 cost over the 5 years. So I'm expensing out $2,000 a year into my income statement in my expense section. So it allows us to recognize the fact that we got this great thing, but also very slowly recognize the cost of it in our expense section through depreciation. And what this does is it really smooths out your income statement. Because if we bought the darn thing and we just booked it as an expense instead of as a fixed asset on our balance sheet, then what's going to end up happening, right? I'm going to have a very smooth looking income statement right until I buy this giant piece of equipment that's going to tank my income statement that month and then go back to being smooth. So this allows us to make sure we're recognizing that expense over the period that we're getting the benefit over a period of time.
Do you mind?
So I hope that answers your question.
Do you mind going to the slide that has your contact information?
Sure, happy to. Here is our basic contact information for TGG. TGG Accounting. You can also connect with us through social media, and I'm pretty active on LinkedIn as well, so feel free to reach out to me.
Next question is, what impact a pass-through arrangement might cost to my consulting service business? What I should proactively do to minimize those impacts, if any?
I might have to get a little bit more specific on what a pass-through arrangement is going to be. If we're talking about pass-through of costs, so to say that what I pay for, in that same example we were talking about a second ago, what I pay for a window is the same thing that I'm going to charge for my customer, then your revenue and your COGS might be exactly the same that we're passing through. But that doesn't necessarily mean that that's a great decision. We have to take a look at your business, figure out what's common in the marketplace, and really, if it's taking you time and energy and expenses to float your customer to get those pieces of equipment or whatever those items are for installation, we may want to charge some kind of upscale cost on those, because I would say that's pretty common depending on what your industry is.
How do you account for insurance costs on buy-sell agreements?
Great question. A little too complicated for this webinar, but really happy to connect on that, Robert. And a question about landscaping business. So if you're a service-based business, if you have a request for a different type of industry that we didn't cover here in general, always happy to really chat. And if we have enough requests, we can always try to set up another webinar to cover that industry in the model. It's really easy for me to talk about service-based industries, because whether you're a landscaping business or if you're an accounting consulting business like me, we're actually going to end up working quite similarly. So a lot we can talk about there.
Thank you so much, Joe and TGG Accounting. Thanks to everyone for joining us for today's webinar. Please join us next Thursday for part 2. Again, you'll receive the recording and slides tomorrow via email. If you want to get one-on-one consulting on your tech or life science business, or if you need additional assistance, please go to the chat for our 800 number and the sbdctech.org/contact link. We're here to help you and your business start, grow, and succeed. Thank you so much for joining us. Please stay safe and healthy. Thanks again, Joe.
Absolutely. Thank you, everyone, for joining us. Take care. Thank you, Julie and Hannah.
Thank you. Bye.